It was a red day on the stock market with the S&P 500 down 1.44% and 80% of stocks within the S&P 500 closing in the red. Naturally, that's going to have an impact on our postures across the various indices, and we do have one major posture change to report in tonight's video. In addition to reviewing that information, we're going to get into some macro analysis where I wanted to point out an inconsistency with one of the key macro inverse correlations that we had been used to earlier this year. We'll also talk about some sector analysis, including which sector is really getting punched in the gut right now and falling and tumbling in our sector rankings. And then we'll get into our trade application example where I wanted to feature a dividend aristocrat that is setting up with a technical indicator that has never happened in its history that might very well offer up an opportunity to do something bullish with it. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's December 6th, 2022. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into the description area and make sure you're signed up for our email distribution list. So that way you can be notified whenever we post these videos. Remember, at the bottom of those emails, you'll also find which stocks are giving you overbought and oversold cluster signals. In addition to that, we're heavy users of Twitter. My handle is @BrandonVanZ, and we really appreciate those of you that click like and retweet on these Market Outlook related posts. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And as you can see from our S&P 500 heat map, it was quite the doozy of a day, an ugly one to the downside. In fact, the second straight sell-off day to the downside. Last time I was with you guys was on Thursday night, and we were talking about the overbought cluster signal and how the market had just touched 4,100, which happened to be a key resistance area for that downward trend line that I had drawn. And I was saying that Friday could be a make or break day where either the bulls could really take it to the upside and really change the narrative, or if the bears were going to step in, that would be the obvious moment to do that. Well, as Friday came along, we did have some reasonable selling during the middle of the day, but by the end of the day, we actually had a little bit of buying to kind of dampen the impact. We still finished a little bit lower, but it just wasn't a very aggressive day. Then fast forward to this week, now we're starting to see more aggressive selling. Both yesterday and today, the bears have really reinserted themselves here into this conversation. So here's what the aftermath of today looks like, where the S&P 500 was down about a 1.5% here at the end. And you can see it was pretty ugly across the board. There were the vast majority of major companies, of course, closing in the red, including stocks like Apple, which were down 2.5%, Microsoft, which is down over 2%. Remember, those two are going to be the most influential companies for the S&P 500, both of them down over 2% today. They weren't alone. Amazon, another very important, almost trillion-dollar company, although these days the stock suffered so much in the last year, you can't count them as part of the trillion-dollar club any longer. They are now $900 billion. I don't think we'll be crying for Jeff Bezos anytime soon. Nonetheless, no longer a trillion-dollar company. They were down 3% here today. You'll also notice that Alphabet was down about 2.5%, so similar to what we saw with Apple. And then we did see Bank of America really struggling today. They were down 4%. This was after a rather ugly session for banks yesterday as well. JP Morgan managed to buck the trend here today. They were just barely closing in the green. But that's because of something specific that happened to them. They got an upgrade in the morning. They were actually up quite a bit more. They gave back most of their gains by the time that the closing bell rang, but nonetheless did manage to close just barely in the green there. But most of the major banks out there, Wells Fargo and Citigroup and Schwab and Morgan Stanley and Goldman Sachs and BlackRock. Some of you saw my tweet yesterday about BlackRock surpassing Goldman Sachs and Wells Fargo as the most hated publicly traded financial company on the planet now. I was, of course, just joking about that, but nonetheless, it does seem like there has been quite the temperature change around BlackRock here in recent years. Nonetheless, whether you were amongst the favored companies or the less favored companies, chances were that you closed in the red today. And again, yesterday, I wasn't with you. You probably listened to David's presentation, but the banks got really hit yesterday. Some of them were down, especially the regional banks were down like 5, 6, 7%. So to have a day like that and then followed up with another day like this where the banks were down again, it was a pretty aggressive 1-2 punch for some of those smaller banks in particular here so far this week. So keep your eye on that story because it did seem a little bit out of the ordinary, a little bit peculiar there. Not the type of price activity that you are used to seeing out of the banks. And remember, the banks are oftentimes viewed as the lifeblood of the economy. If you want a really strong economy, you want the banks participating alongside that economy. So hopefully this is not giving us a warning sign for the future. Of course, we know that we've been struggling with an inverted yield curve for much of this year, and it seems like it gets worse and worse by the day. We'll see if that ends up being a precursor for an economic recession and a continued bearish stock trading environment as we head into 2023. So, some really ugly performers out there today. The vast majority of stocks closing in the red. There really wasn't much in the way of buying today. You had a little smattering of buying there in the healthcare area, and then I would say from a more consistent perspective, the utilities actually had a pretty strong day here today. So let's go ahead and right-click into there, look at the utilities. And you can see most of the utilities actually closed in the green today. You had one obvious exception down below. Dominion was down a little bit as well. Some of you saw my tweet last night about Dominion and their Cove Point LNG exporting facility and what their future holds with that, with their partnership of Berkshire Hathaway. But anyway, the one that stands out even more than Dominion is this one down here. NRG Energy was down 15% today. So it was a very oddball day where utilities were the only sector that closed in the green today, but literally the worst stock in the entire S&P 500 was in the utility sector. That generally does not happen. But this was the worst performer in the S&P 500 today, down 15% as word broke here this morning that they are buying Vivint Home Solutions, which has things like home security and solar and different things like that. It's actually a company that's based out here in my neck of the woods in Utah, so that kind of caught my attention when I saw that buyout news go through. And speaking of Vivint, some of you saw my pictures on Twitter on Saturday from Vivint Arena, where I have to give my partner there a little bit of ribbing as my Coyotes from the University of South Dakota came to town and took care of business against David's alma mater, the BYU Cougars. And my Coyotes are a very small school, and it's very rare for David and I's alma maters to be facing one another in any sport. This was actually the very first time they had played each other in history in men's basketball. And I checked on ESPN before the game started, and the University of South Dakota Coyotes, and yes, we are pronouncing it correctly there. So that's how we know if we've got outsiders amongst us, if they call them Coyotes. But anyway, the Coyotes were expected to lose by 12 points, meaning that we were a major underdog, not expected to win. But for some reason, we just lit them up on Saturday and ended up beating BYU by 1. So David's been a very good sport about it. I'm sure he's not too happy about that, because if we played each other 20 more times, I'm pretty sure that his team would have beat mine 20 times in a row. But we just happened to have his number that particular day, and it was a blast to take my 8-year-old son to the game with me, where we sat nearly on the court. and it was his very first basketball game that he's ever attended. So from that very aspect alone, it was a thrilling day there. So the Market Scholars rivalry is now done, and you probably won't have to hear that any longer. But that was the reason you saw me wearing my Coyotes hat once again on the intro here tonight. So anyway, I was at Vivint Home Arena here on Saturday, and that is the naming rights of that arena where the Utah Jazz play the NBA games is the company that got bought out by Energy here today. So that was the reason that stock was down so much, is apparently the market thinks they're paying too much for the merchandise, and they might very well be doing that exact thing. But otherwise, utilities, as you can see here, a fantastic day for the utilities in relationship to what happened to the rest of the market, right? The rest of the market got annihilated. The utilities actually hung up there like champs. We have a swing trade going right now, a bullish swing trade on Southern Company. And so we were happy that one of our bullish trades actually worked out for us here, because I can imagine most bullish swing trades probably didn't fare too well here today. In fact, one of the bullish swing trades that I did for this market outlook video, the Norwegian Cruise Lines, unfortunately, was stopped out today. And I'm sure I wasn't alone in that regard. There were a lot of trades that got stopped out today if they were long. The good news is a lot of our bearish trades have been doing quite well, including Airbnb. I'm still in, by the way, the Datadog long put spread as well. And with that stock now below my my sold put price, in addition to my long put price, we are basically in the sweet spot as we head into expiration next week. So keep your eye on Telegram if you're a premium member. If I do decide to get out of that Datadog trade, I'll let you know there in Telegram. But right now, we are in really, really good shape on that particular trade, as long as the markets don't somehow just magically reverse higher. So your bearish swing trades probably working out pretty nicely today. Your bullish ones probably not working out quite as well. Although if you happen to have a bullish swing trade in the utility space like we did with Southern Company, then you might have fared a little bit better than others outside of the utility space. All right, let's go ahead and now pop on over here to the main part of the platform. Take a look at our breadth measures. And as you can see, I've got the S&P 500 pulled up here in the Index Watch of the Market Watch tab. And you can see that with our advancers today, there were about 100 advancers to about 400 decliners. So that was good for a split of approximately 20% of stocks closing in the green today, 80% of stocks closing in the red. So this was not a day that you had to guess too much over. It was a day where it was blatantly obvious that it was owned by the bears, just like yesterday was, and probably not a great sign for what the future holds, at least here in the short term. Back over here to our charts now, you can still see that I have my black line on the S&P 500's chart that I shared with you guys when we were last together on Thursday night. Remember, I do the videos on Tuesdays and Thursdays. David does them the other days. So when I was last with you on Thursday, that would have been right here on this candle. And you can see it was just touching the top of that black line. That was the day when I was talking about how we hit 4,100 almost exactly. If you look at that H colon up there, and I go back and point at this, the high on that day was 4,100 spot 5-1. And so kind of interesting how that big round number became such an obvious resistance point, but teaming that up with the fact that this downward trend line laid so nicely atop the other lower highs that had unfolded throughout calendar year 2022 made that an obvious point for the sellers that were out there. In fact, if I have any concern about it, it's almost like it's too obvious. And I'm questioning, well, if I'm seeing this, certainly everybody's seeing it. And the market generally doesn't let you get away with the easy layups, right? The market is usually a bit more difficult than that. So I'm not here to say that that we're done with whatever move had been happening previously, but right now it does look like the bears are taking back control of the market, which was my hunch. Obviously, hunches don't always plan out, but right now, bouncing down and away from that falling trend line there is not a great look for the market as we head into the year end. And remember, there's going to be a lot of tax loss selling this year as well. Normally, December is a pretty strong month for the markets, seasonality perspective, but usually stock markets are up during the year. Maybe 1 out of approximately every 3 years throughout history, you have a down or flat market, but 2 out of 3 years throughout history, you have an up market. So that means that 2 out of 3 years, traditionally going into December, you have a plus sign in front of your performance that year, and therefore you don't have as many stocks to sell for losses when the markets have gone up in the 11 months prior to that. This year does not represent that situation. This year represents a situation where lots of losses have been piled up in various brokerage accounts out there. And if you happen to have those in taxable brokerage accounts, then it might make some sense to sell off some of your losers to offset any winners that you might have had for tax purposes. So we might end up having a little bit more selling as a result of that phenomenon here this year, in addition to just what we're seeing organically from a technical analysis and charting perspective here. When we were talking about that S&P 500 at 4,100 here just a moment ago, another thing that I found interesting is if you look at SPY, which remember is approximately 1/10 the value of the S&P 500 itself, but SPY is what you can use to trade the S&P 500. Remember, the S&P 500 itself is an index, so you can't really trade it. You can trade options on it and things like that, but you can't actually buy the S&P 500, the index. But you can buy SPY as a representative of that through the world of ETFs or exchange-traded funds. And interestingly enough, on Thursday, it touched $410 exactly, not even a penny past it. So again, look at the H colon up here where I'm kind of circling with my mouse, and I know some of you watching this on a small phone or a different device where you can't see that very well. I'll just read it to you. But when I go back over here and point at Thursday's candle, and the H colon up there says 410 exactly, not 410.01, not 409.99, but exactly 410 to the penny is where the sellers came into that. And we've now had basically 4 days in a row of selling for the S&P 500 since that big round number was touched. Now, in terms of looking at this chart, remember, I usually like to bring up this chart 6D to have our conversation in this presentation whenever we have a day where the S&P 500 was either up or down by more than 1%. And today represented that very thing with the S&P 500 down 1.44% here today. You can kind of see how that looks here in the middle of the chart. You have this black zero line that kind of goes across horizontally there. And then you have these corresponding colored vertical or horizontal lines, I should say, that are kind of stacked above it and below it. And these labels over here will basically tell you what those different levels mean. So in today's case, that blue label says a 1% price move. Since it's below the black horizontal line there, that means it's a negative 1% move. And this is the second straight day that we've had back-to-back 1% sell-offs. And I think that David was actually tweeting about that earlier today as well, where he was talking about how when we had some of these other sell-offs in the past, you were oftentimes met with those types of days where you had multiple days in a row of 1% sell-offs, right? Back here, you had a couple of 1% sell-offs. Back here, you had a couple of 1% sell-offs. So it can happen. Here's another one, kind of when you're bouncing down and away from that moving average or that trend line. You had 2 straight 1% days. So sometimes that's what kind of kicks off the selling is back-to-back 1% moves lower. And so we'll all find out together if that does so once again. But right now, it's looking like that's a distinct possibility here, as we are expecting the sellers to step back in after having such a remarkable move off the lows. Remember, that was a very impressive move. That was not just a meh type of a move. That was a legitimate move to the upside, where we saw, in some cases, a lot of stocks go to all-time highs, right? Some of you that follow my my Twitter feed know that I like to tweet out the stocks that are hitting new all-time highs, especially on Fridays and over the weekends. And so, stocks like General Dynamics and Genuine Parts and, stocks like McDonald's and Pepsi over the past month have been hitting highs. And so there's a ton of well-known American companies that not only are hitting 52-week highs, but all-time highs here within just the last few weeks. That's how aggressive that move has been off of the lows there. So it's probably time to give back some of those gains. Markets are cyclical, just like night follows day, selling follows buying, and vice versa. That's how these things work. But we're in a more prolonged bearish type of a trend, as you can see right here. And until we can cross up and through that black line, I'm going to be more cautious with my stance towards the markets. Now, naturally, you can always find opportunities in a market. We had a good conversation today in my dividend growth investing class for our premium students about the proper mindset and psychology that is required to be a good investor for the long term, which includes being able to absorb losses in a diversified portfolio if you are planning on holding stocks for, let's say, several years or decades into the future. Automatically you are going to be holding stocks when they are going lower. That's the nature of the beast. You can't possibly hold a diversified portfolio of stocks for the next 10 years and somehow assume that you're going to magically avoid the time periods when the stock market is losing money. So there's no way to avoid that. If you're a trader, which is what we teach a bit more in these presentations here with technical analysis, that is what you are hoping. You're hoping to define those moments in time where it makes more sense to step aside and away from the market, and then look for those opportunities when it makes more sense to step into the market. Now, each of the approaches, whether you're a trader or an investor, is going to have tons of pros and cons associated with each. So it's just a matter of what is your personality, what are your traits, what are your skill sets, what are you hoping to accomplish, what type of risk are you willing to assume, what are your goals. And that's unique to all of us, right? So hopefully by giving you a well-rounded education here at Market Scholars with everything from short-term swing trading to long-term buy and hold dividend growth investing, you'll find a class or two that makes sense for what you're hoping to accomplish. David and I would always urge you to play into your strengths and do what has made you successful in the past. Let's take a look at some other charts now. Pop on over here and take a look at our 4 grid and see kind of where things stand from a market forecast technical indicator posture perspective at the moment. And somewhat surprisingly, despite the pretty aggressive selling that we've seen in the last 2 days, 3 out of our 4 major charts do remain with the bullish posture, with that green background color suggesting that on the S&P 500, the Dow Jones Industrial Average, and the NASDAQ Composite. The only exception to that is the Russell 2000. Notice that the Russell 2000, like the other indices, has had a pretty rough 2-day drop here, both yesterday and today. And with its drop, it has easily breached its 30-day moving average. And now you can see that its green line down below here, in fact, let me right-click and maximize this so you can see it a little bit better. That's the reason that you have that pink background color on the chart now, is that green intermediate line has now fallen out of the upper reversal zone, in addition to obviously the price candles up above breaching a key support area of the 30-day moving average itself. It could also probably get away with saying that you had a fairly reasonable horizontal support area that was kind of sliding across this candle here on November 17th, and then again here on these 3 candles just last week. And today you breached that horizontal support area pretty easily as well. You did have a bit of buying at the end of the day. Some of you already know what trade application I did, which was selling a put, which is what I oftentimes try to do when the markets are down more than 1%, but it actually worked out fairly nicely from that perspective because I placed the trade about a half an hour or whatever it was before the market closed. And of course, I always send out that telegram to all of you who are premium members, so that way you can be notified before everybody else in the free audience later that night. But today was one of those rare days where I was thankful for the way that the market kind of had a little bit of stability at the end of the day, because markets actually did have a bit of a rally there. It wasn't much of one, but you can kind of see those little shadows that are showing up underneath today's candle, where it was not one of those days where you continue to sell off into the close. And sometimes that can happen, right? Like back here on the NASDAQ chart, this would be a classic example of closing at the low. Back here, you closed at the low. Back here, you pretty much closed at the low, right? Back here, you closed at the low, right? So that happens quite a bit. Today was not one of those days where you did have a little bit of buying pressure coming in for the last half of an hour. Don't want to make too much of it, because obviously it was still a pretty ugly session, all things considered. But it does go to show you that there is still some interest out there for folks of buying the various stocks when they become more valuable. In other words, when price is more attractive after having gone down, as opposed to the opposite in buying stocks after they've gone up, right? So there's always going to be that value-focused cohort out there that is more interested in buying stocks on days like today, as opposed to buying them after they went to new highs last week. So perhaps some of the value investors wanted to kind of sniff around here at the end of the day today, looking for opportunities. But it was surprising to me. I figured when I pulled up the foregrid today that after such heavy selling for 2 days in a row, we'd probably see more bearish postures. But shockingly, there was just one. Russell 2000 is the only one. The NASDAQ is probably sitting right there. You can see down below that its green line is kind of close to that lower reversal zone, and you can see that the NASDAQ also has a yellow moving average, similar to what the Russell 2000 has. So both of them closed today. NASDAQ just barely closed. In fact, you can barely see it with the naked eye. So let's right click on that as well. But here you can see, if you were to click on the candle, or at least hover your mouse over it, the lower right-hand corner of that red box is where the close was, which is just barely below the moving average itself. So that's why that moving average color, the 30-day moving average color, changed from green yesterday to yellow today, because price did fall below a rising moving average. But also notice that moving average looks, to my eye, to be almost flat as a pancake right there. So there is also the possibility that could roll over, right? This could have been viewed as just a rare moment of reprieve for the bulls out there. And now the sellers are coming back. We could slip back into a red moving average, similar to what we had for most of the fall back here. So let's keep our eye on that possibility as well, because if the NASDAQ sells off again tomorrow, and it's a heavier type of sell-off day like it was today, where it was down 2%, it's entirely possible that moving average could actually be pulled lower starting as soon as tomorrow if the day is aggressive enough. So then all of a sudden you might be staring the possibility of a red moving average, and this green line would have a chance to fall out of that upper reversal zone to plot that pink background color there as well. Just basically a way to confirm that there is more bearishness in the system once again. So to kind of put a bow on it, the S&P 500 was down 1.44% today. It remains with a bullish intermediate posture. It's still above its rising 30-day moving average, and it actually closed today with a bullish intermediate confirmation signal. Remember, that occurs when the when the green line is considered bullish, like it is right now in the upper reversal zone, combined with the red momentum line in the lower reversal zone on the same day. And the blue line is not technically part of that particular trade setup. However, we do tend to use that blue line to help us filter through to see which setups are better and which ones are worse. And with all of our cases today, so I'll just let you know now so I don't have to repeat myself over and over, that all 4 of these charts did have that red line close in the lower reversal zone today, and you also had the blue line closing in the lower reversal zone today. Now, technically, the Russell 2000 did not have a bullish intermediate confirmation signal today because its green line would not have been considered bullish because it fell out of the upper reversal zone. But on the other 3 charts, they are bullish intermediate confirmation signals, but none of those 3 would be considered the ideal form because the blue line did not close between 50 and 20. And that's generally where you want to see it. Sometimes what this leads you to believe, when the blue line pushes itself all the way into the low reversal zone like this, is that the selling is more serious. And remember, the bullish intermediate confirmation signal is effectively a buy the dip signal. And so with that blue line selling off so aggressively into the low reversal zone, as opposed to just kind of gently residing between 50 and 20, it's telling you that you should take this selling that we experienced the last couple of days more seriously. This may not be a dip that you want to buy, right? Maybe we'll get more clarity around that point in coming days. Remember, we've got an interest rate announcement next week from the Fed. So we've got lots of important stuff on the horizon here before we close up the year. But right now, it's kind of giving you the heads up that this may not be the ideal buy the dips setup right now, because it's giving you the insight that the near-term posture is too aggressively bearish here for having that type of a bounce type of a trade that you would want if you were to buy that dip. So the Dow Jones was down 1.03% today. NASDAQ Composite was down 2% today, and the Russell 2000 was down 1.5% today. So one of those rare days where all four of these indices were down more than 1% today. We haven't had a lot of days like that in the last couple of months, so this kind of felt a little different all of a sudden in the last two trading sessions. Let's go ahead and pop on over here to the internet briefly. I always like to get a chance to say thank you to those of you that help support these free videos that you watch here. Now, my videos are typically about an hour in length, assuming that you guys vote with your likes, that you want the full-length video. That includes the 12 grid analysis and doing a trade application example and all that kind of good stuff. And so it takes not only the hour that we're recording these videos out of our day, but naturally it requires us to edit the videos and upload the videos and write the paragraph that goes along with the emails for the videos and all of the prep work in order to locate a trade idea while the market is open for you guys, in addition to sending out the emails and notifying all of you on social media of this and all that. So the point being, all in, this free video that you guys are watching right now will take at least 3 hours of my day. And so I always urge you that if you want me to continue doing the videos, if you enjoy them and get benefit out of them, that all you have to do to encourage me to continue to do them is give up 5 seconds of your time by clicking the like button on Twitter. So give up your 5 seconds for my 3 hours, and then we can have a nice healthy trade-off with one another right there. And today we got up to 103 people clicking like. And that required some kind souls within my premium class today to get us up and over 100, because we were just barely below 100 when we started the day. So if it wasn't for those kind souls in my class, I would already be done with this video, because it would have only been a 15-minute video. So again, would encourage you to get into that habit with both David's videos and my videos, that if you appreciate the effort that goes into producing this for free for you, all we ask in return is a little bit of support there on social media. And we really appreciate those of you that have been willing to do that for us over time. So let's go ahead and do some shout outs in that regard. Thank you to Stephen. Thank you to Carlisle. Thank you to Irene. Thank you to Stacy. Thank you to John. Thank you to Dean. Thank you to Jeanette. Thank you to Judy, Dr. Bob, Jim, and Brandon, and Dave, and Ken, and Irene, and others. Can't get through all of you here today because it would just soak up too much time, but I do appreciate each and every one of you. So thank you for that, and please keep that up. Again, assuming you want me to do these longer length videos. Some of you may actually prefer that I do the 15-minute version of it, and that's fine as well. If that is your preference, then don't click like. And then whatever side of 100 we end up on by the time I'm scheduled to do the video again on Thursday will dictate what sort of a video I produce for you that day. So if you only want the 15-minute version of only the indices and no additional analysis and trade ideas, then don't click like. Otherwise, if you kind of like these longer form ones where we get the opportunity to look at a lot more charts and go through a trade idea with you, then just take the 5 seconds out of your day to click like for me there on Twitter. And remember, there's 4 different ways to do that. You can come over here to my timeline, just twitter.com/Brandon Van Zee. And my most recent market outlook video will be pinned at the top just to make it easy for you to find it. Otherwise, remember, you can also find it directly under the video. If you're watching it on our website, we have these little embedded Twitter widgets. And so you can just click the heart button right there if you don't actually want to go to twitter.com. You can do that as well. Otherwise, we also have the link to the tweet in question in the description area of the YouTube video for those of you that watch it directly on YouTube. And then we also have a icon on the emails that we send out. That's the Twitter icon, and if you click on that, it'll take you to that. So there's 4 different ways. Whatever way you prefer and is the easiest for you, feel free to implement that. Earlier today, we had some excellent classes, as we always do. David taught his directional option strategies class, so make sure you check out that recording if you're a premium member, if you haven't had an opportunity to yet. And then I taught my dividend growth investing class earlier today as well, where we concentrated on the communication services sector for an opportunity within that area. And part of that was spurred on by this post right here, the dividend stairstep sector statistics, that suggested that the communications area was the one that was so far out of favor price-wise that offered up the best dividend yields. And as long as we trust those dividends to continue to be paid into the future, they may very well offer up an opportunity for us. So anyway, feel free to check that out as well. Let's talk about our sector selector tool here. Remember, I put this together on Friday evenings. Actually, this week, this was put together on Friday evening, and I had to wait until Saturday morning to do the other tool that I update for my premium members on the weekend, the stock selector. The reason for that is Thinkorswim was going through some late night maintenance on Friday night, and I couldn't access the normal data I needed to produce the data for my tool. But anyway, the sector selector was posted on Friday nights, and that is typically the case. Usually, after the market closes on Friday, I gather up all of my necessary data and then put out the rankings of where there is strength versus weakness on a relative basis within the market. One thing to also keep in mind, this is on an equal weighted basis here. I've been spending a little bit more time reminding you of that lately because consumer discretionary, as you can see, is now at the top of the ranking. And if you're somebody that's looking at XLY, you're probably wondering how in the world that could be. But of course, XLY is basically influenced to a great degree by Amazon and Tesla, 2 of the worst stocks in the market right now. And because the reason behind that is because they're market cap weighted. Whereas an equal weighted approach is not going to give extra emphasis to Tesla and to Amazon. It's going to look at every single company within that sector with the same merits and ask the basic question, is the typical stock in this sector doing well or not from a price perspective? And if you go through all of the consumer discretionary stocks in the S&P 500, you're going to find a lot of uptrending charts, but that's going to be somewhat hidden from a lot of folks if they're only looking at the market cap weighted basis. So anyway, that's been a really interesting element of this market here recently, is that there are a lot of retailers out there that are doing very well right now, but because Amazon and Tesla are doing so poorly, it's basically masking it for most people, other than those of you that watch this presentation, because of course I've talked about it for a few weeks at this point. But today is the first time I can make the announcement that consumer discretionary made it all the way to the top. Right back here at the beginning of November, it was in the 8th position, and it had this massive week over week move up here to the number 3 spot. And some people were probably wondering, was that just a flash in the pan? Was that a glitch in the data? No, it wasn't. It actually continued to build upon itself and has made its way all the way to number 1 here. Now, because it's made its way to number 1 for the first time in the rolling 3 months of this graphic, it had to replace a sector at the top. And the sector that it replaced was industrials. And that was a rather short stay that industrials had up there. Remember last week when we talked about this, that was industrials' first time at the top in the previous 3 months, largely because energy had been dominating at the top for most of this 3-month period. But a couple of weeks ago, energy really started falling out of bed. That's when I've started to use that term wobbly with you guys in relationships to how I described the activity within the oil and gas stocks recently. They have not been the stalwart group that they were here a few months ago. Nonetheless, there's always an opportunity for rotation to take place, right? Wildfires burn down forests and open up the seeds for new trees to bloom and blossom into future years. And so perhaps we're going through that type of scenario right now where the oil and gas stocks are starting to burn down and it's giving way to new seeds from new areas out there like consumer discretionary, industrials, and the like. So anyway, that's a key theme I think right now, is that the energy area has really taken it across the chin. It's also interesting to me that financials did so poorly. Financials, obviously the last 2 days, as I mentioned before when we were looking at our heat map, have done very poorly, but this was put together on Friday, so it would not have known that in advance. So even prior to the last 2 days, financials have started to maybe become a little bit less interesting from a price momentum perspective. And with both of those struggling, I'm going to guess, I haven't looked at the information yet, but tomorrow morning I'll be teaching my factor-based swing trading class, where we look at the factor selector. And I'm going to guess right now that the value factor probably will suffer on a week-over-week basis. And the reason I say that is the value factor is chocked full of both financials and energy. So if financials and energy have all of a sudden been doing poorly, then value itself may struggle on a week-over-week basis from a factor perspective as well. So we'll all find out tomorrow morning in that swing trading class, if you're a premium member of mine at least. So anyway, kind of an interesting week-over-week movement within the sector selector, where we did have a lot of moves, right? Back here, some of you will recall when I showed you the sector selector here 2 or 3 weeks ago, we only had one single change that entire week, and that was in the 5-6 position right here that I'm kind of circling. This week, pretty much all the positions changed. In fact, all of them except for one did. The only one that stayed the same was healthcare. Healthcare was number 4 last week. It stayed number 4 this week. Every other position did show some sort of difference from the previous week. So this was a week where we had a lot more kind of aggressive turnover that was taking place. All right, let's go ahead and pop back on over to the main part of the Thinkorswim platform now. Let's do some 12 grid analysis. And let's take a look here at chart 5A. And so this first set of 12 grids is basically going to show us different asset classes, right? It's not going to only show us things that are happening in the stock market. The stock market remains probably the focal point of this presentation each night, but it doesn't mean it's the only thing, right? We like to also dig into the macro. What's going on with bonds? What's going on with interest rates? What's going on with commodities? That sometimes can help us understand the stock market a little bit better. So let's get into it, see what we can discover here with the 12 grid today. And in the lower two corners, the lower left corner is the US dollar, lower right corner is the 10-year Treasury yield. That's where I've started my conversation more often than not with these 12 grid analysis that I've done for you guys in 2022, because it's really been the storyline of the year, right? What's going on with interest rates and with the US dollar. And what has been kind of interesting here with at least the 10-year Treasury yield is that we haven't really seen a bounce back in Treasury yields, even though we do have a sell-off in the stock market. Remember, previously, those two things were kind of inversely correlated, where you had this period of time down below on the 10-year Treasury yield going up during September and October. And notice on the S&P 500's chart, you had price activity going down at that same time. Then we hit a bit of a tipping point and we went up a little bit too high on interest rates, and interest rates started rolling over towards the end of October. Well, guess what? That middle to end of October is exactly when the S&P 500 started going up. So that inverse correlation seemed to hold during those two major periods there. But what's kind of interesting about this past week or so is that ever since we got that overbought cluster signal there at the exact top on Thursday, when the last day I was with you, the day when the SPY hit exactly 410, it has now sold off 4 days in a row. And if you look at the 10-year Treasury yield, we've only gone up 1 out of those 4 days. So it's almost as if it's not rising interest rates that is concerning the stock market right now. It's almost as if this is more profit-taking opportunity that market participants see within the S&P 500. And so there's a little bit of a temperature changer. I want to keep my eye on it. Again, I don't want to make too much of it because it's only 3 or 4 days. But I just wanted to point that out because it felt a little bit different than what we had seen for much of the previous year. And perhaps that's telling us that maybe the bulls aren't done yet. Maybe this was a little bit of profit taking there, but there's not an actual macro reason to get too upset about the market right now. Maybe the bulls will buy this opportunity up and off of that rising moving average, right? Who knows? I think there's still a lot of other debates and conversations that could be had out there as to why stocks don't deserve to be up at these levels, including valuation. Nonetheless, sometimes that takes a little bit of time to play out. And so we have to have this tug of war between bulls and bears as well. So we shall see, but it is kind of interesting that this is not what we had expected and what we had seen earlier in the year, where we've had 4 straight sell-off days for the S&P 500 and 3 out of 4 sell-off days for the 10-year Treasury yield itself. Notice that the Treasury yield remains with a strongly bearish posture, continues to trade below that falling 30-day moving average. Dollar's a little bit different, but not dramatically so. Remember, the dollar and the Treasury yields have effectively kind of followed each other this year, right? As opposed to what I'd mentioned before, where there's an inverse correlation with the U.S. stock market and the U.S. Treasury yield. More to the point this year, there has been an actual correlation between the Treasury yield and the U.S. dollar. When one of them went up, the other one went up. When the other one went down, the other one went down, right? So those two kind of have held the line together with each other this year. But a slight difference between the two is notice that the dollar was up today. Not by much, so I don't want to make too much of it, just barely up. But nonetheless, it was its second straight up day on the US dollar, whereas it was a reasonably strong sell-off in interest rates today, down to 3.51%. Remember, we were talking about 4% interest rates just a few weeks ago, how quickly that has changed. And all of a sudden, you're down there at 3.51% or 3.5% if you want to think in big round numbers, right? It's still way higher than where we were a year ago. Nonetheless, we are significantly off of the highs. In fact, I'm curious for myself on TNX. Let me go over to the trade tab real quick and look at TNX. And I'll tell you that the high on TNX this year was 4.33%. So it's not quite 100 basis points lower than that right now, but you're in that general vicinity. Remember, in past years, it had been noteworthy if the entire range of the year was 100 basis points. And we're talking about that type of a move taking place here in really just the last 2 months or so. So it's been an aggressive year for interest rates for sure. And this has been a pretty legitimate give back in interest rates. And of course, the corresponding move to that, when interest rates go lower, of course, bond prices go up. And that's exactly what we've been seeing out of TLT here. TLT at one point today on an intraday basis actually hit a 2.5-month high. Not quite a 3-month high. But remember when we were talking about all of those oversold cluster signals here on TLT and how it just felt like the house of pain day after day after day? Now we're seeing the exact opposite of that. We have seen all of that misery unwound, and now we're almost to the point of euphoria, right? We are almost at 3-month highs on TLT because that's how aggressively interest rates have rolled over right here. Part of that is, just the market's anticipation of the Fed eventually needing to probably cut interest rates in the future. Now, the Fed has not actually come out and suggested that. It's the market's assumption that will need to occur at some point next year if the economy does actually go into a recession. And in a way, the Fed almost wants to create a recession because they want to cool inflation. They can only control the short term. The long term is oftentimes controlled by market forces, but sometimes the market is thinking in advance about what the Fed will eventually have to do. And perhaps that's what the TNX is sniffing out right now. We shall see. But it has been a heck of a run there for the bond market, up and away. And remember, TLT has lagged what's happened in the foreign bond market. Foreign bonds did legitimately hit a 3-month high here today. High yield bonds didn't quite do that. In fact, high yield bonds have now sold off 4 days in a row. That's another educational point that I've tried to instill upon you guys over the last couple of years that other people don't necessarily pick up upon. And that is high yield bonds have a higher correlation to oil prices than you will expect and that you will find with other bond categories out there. Part of the reason behind that is high yield bonds are also known as junk bonds. In other words, those are the sketchiest of businesses out there that have no other choice but to raise capital in the most expensive way possible, which is in the junk bond market. And several years ago, there were tons of oil companies that were on the brink of disaster when oil prices were really low that had to basically raise high-yielding debt at that time. And so you will find that on occasion, the high-yield bond market will respond a little bit more to oil than it does to interest rates. And for most people, that doesn't make sense at all. Most people are taught that interest rates always dictate bond activity. Well, today is simply not the case. Today you can see interest rates fell. High yield bonds also fell. They weren't down much, but they were still down on a day when government bonds were up very, very nicely. So high yield bonds are responding to not only oil prices themselves, but it's also a way to kind of gauge risk on versus risk off appetite that's out there. And with this being the second straight 1% plus sell-off day in the market, you could categorize today as a risk off type of a day. So naturally the riskiest bonds also struggle on a relative basis compared to what are perceived to be the safest bonds, the U.S. government. Obviously, government bonds can be traded at a loss, but if you hold government bonds until maturity, you should be made whole unless you believe the U.S. government will implode, which very few people do, especially since we do have the world's reserve currency. So we have some benefits there. So anyway, today was one of those days where high yield bonds is telling us it was very much a risk off day, and it was also a day where oil prices got smashed. Oil prices were down 3.68%. That was their third straight sell-off day, and 2 out of those days were really ugly sell-offs. And you can see here oil is down here, testing some of these lows over the last 3 months. I think there's this general impression out there that oil remains a really strong area of the economy, but the truth of the matter is oil prices are actually testing some of their multi-month lows right now. Yes, they're up, from their lows over the past couple of years still, but there's some considerable wear and tear on this chart right here. There's some actual selling pressure that has come into the oil markets. Notice that gold is the opposite. Gold was actually up today by 0.27%, and remains with a strongly bullish posture, and it's well above its rising moving average. So in other words, there's a decent chance that this was actually a trend-changing type of move here for gold, what we witnessed within the last 3 months. Remember, prior to this 3-month chart, gold had been in the house of pain, going lower and lower and lower. This was such an aggressive move off the lows here that even if we have a normal give back, your chances of staying within a series of higher highs and higher lows is pretty strong with gold right now. Remember, sometimes gold can benefit when markets in general are more chaotic. And so if we do go into a period of time where we go back into kind of a sell-off mode in the stock market and money is trying to flee out of riskier assets into what is perceived to be safer assets, it's possible that gold could benefit in that environment. It didn't earlier this year, and that's what made it peculiar. And of course, we talked about it the whole time. But, if it kind of reassumes its traditional role, then that would not be all that far-fetched. So could I envision a year in 2023 where the stock market is down considerably and gold is up and bonds are up? Absolutely, because bonds and gold are oftentimes viewed as safe havens and bastions of safety when the stock market is getting pummeled. That's what makes 2022 such a peculiar year, because the bond market has been pummeled this year and the gold market has struggled this year as well, but both of them are nicely off of their lows here recently, and I would not be surprised at all if we see relative strength out of those two categories into 2023 while the stock market participants continue to suffer. So keep your eye on that possibility there as well. Let's go ahead and take a look at some sector analysis now on the Sector 12 grid, which is chart 5C. And as we pull this up, we only have 2 pink charts on the board. We've got a dark shaded pink over here on the right, and that's energy. And remember, that was already the case last week. Not just when I was with you on Thursday, but also on Tuesday. Both of those days we had a light pink background color for energy, and it was the only one of the sectors that had a bearish market forecast posture. The difference today is not the pink. It's still pink. It's just that it's a dark shaded pink, meaning that the sell-off has become more aggressive, and this is now considered strongly bearish. And so, going back to what I had mentioned on the sector selector, remember most of the selling on this chart has happened just in the last 4 days in a row right here. But that's the benefit that the premium members have, is we kind of were given a heads up on this sell-off in advance, right? Because energy is already down here in the 8th position, whereas 3 weeks ago it was number 1. So we've known over the last 3 weeks that not all was right and well in the world of oil and gas stocks, and we're starting to see some of the consequences of that, because this has been a pretty sharp sell-off that we are witnessing right in front of us from energy. So it does seem like that idea of sector rotation is legitimately taking place here. They're not just dipping their toe at this point. This is a more aggressive sell-off here. The other one that joined them this week was discretionary. But again, I will emphasize here, and maybe I'll do this. I will right-click on discretionary, and I'll maximize that cell. And discretionary, from a market cap weighted perspective, XLY in this case, does look somewhat bad, right? It's below its falling moving average with that bearish posture from the market forecast perspective, because that green line is rolling over. But remember, what drives my sector selector rankings is not a market cap weighted approach like this, but instead of equal weighted approach. And if you use RCD to kind of gauge that, that is your equal weighted consumer discretionary ETF, and it's like night and day difference. Notice that RCD actually is in a very significant uptrend, well above its rising moving average, and strongly bullish market forecast posture with that green line easily in the upper reversal zone. You'll also notice that RCD, again, which tracks the equal weighted consumer discretionary sector, is up 6.54%. Even after selling off in the past week, it's still up 6.54% over the last 3 months of this chart. And then when I go back to XLY, it is down 10%. So now you understand why there is such an extreme difference there. One of them being up 6.5%, the other one being down, not up, but down 10%. Those are two night and day differences right now, and the reason behind that is because this product right here, XLY, is so driven by Amazon and Tesla that it is basically crowding out the positive impact of the smaller discretionary stocks out there. Look at how awful Amazon looks right now. They're down 30%. They have a huge weighting within XLY. Tesla is another one that's down 34%. They have a huge weighting within XLY. In fact, I think if you go over here to the Analyze tab and then click on XLY, it will actually show you how important the various companies are within XLY. And notice that Amazon makes up 18% of the entire sector, and Tesla makes up 15%. Home Depot and McDonald's are also somewhat influential, but really Tesla and Amazon are 3 times more important than the third biggest component within this ETF. So anyway, those two, when they're out of favor, it's almost a guarantee that XLY is going to look bad, even if all the rest of the consumer discretionary stocks look pretty strong. And that's what we're experiencing right now. This is the Amazon and Tesla effect that we're looking at right now with XLY. All of the other charts do remain with the strongly bullish postures for now. We'll see if that changes in the days to come if we have further selling. But for right now, we still have enough wiggle room there from the good graces that the bull market or the bullish trading conditions brought us here in the last couple of months. Today's only winning sector, as I mentioned previously, was utilities. They were up 0.62% today. All the rest of the sectors were down. Communications was down 2.88%. So they were our worst performer today. Let's talk about our trade application example now. And I want to talk about a well-known dividend aristocrat stock that has caught my eye today for a specific reason. I'm going to pull up the dividend stair-step chart. And normally when we look at the dividend stair-step chart, we use it on a weekly basis. Up here, the default mode, as you can see in the upper left, says 10-year weekly. So 10 years in length, and each one of the bars is 1 week. But what I want to do in this case is I'm going to change this from a weekly chart to a 20-year monthly chart. That's what that M stands for right there. So once I do that and then pull up ticker symbol MDT, this is Medtronic, and I wanted to point out that something is happening to Medtronic right here in this month right now that has never happened to it ever before. That's really saying something. You can't get away with saying something like that very often, but it is true. Notice that there's this little green dot showing up here on Medtronic, and what that is referencing is that on the market forecast technical indicator, that when you're using a monthly aggregation period, you have an oversold cluster signal using a monthly philosophy, and that is quite rare. In fact, one of the kind of interesting historical elements from that conversation that I like to share with people on occasion is if you were to look at the S&P 500, so pull up SPX and look at it from a monthly chart perspective, there has been just one monthly oversold cluster signal that has occurred on SPX, and guess when it happened? It happened exactly at the lows in February of 2009. So this gives you some perspective here as to how rare oversold monthly clusters are on high quality indices and or stocks. And for Medtronic, this is the first time that has occurred, what we are dealing with right now. That's how aggressive the selling has been in this traditionally pretty boring company. This company now has a yield of 3.5% and is in the blue zone of the dividend stair-step chart. So what I did was I sold the $70 put for the month of January. And anytime we have a big sell-off day like we did today, I look for those put sales to look for that opportunity because it provides me an advantage as a put seller. Volatility is up, right? The VIX was up today. I think it was only up a little bit, but it went up from like 20 to 22. So I got more juice to sell puts today than I would have if I did the exact same trade yesterday. And I usually try to target the 1% return on risk area. So I sold the $70 put and I got 70 cents for selling that particular contract. Now what that puts me on the hook for is I am now responsible for buying 100 shares of Medtronic if it closes below 70 on expiration day in January. Otherwise, I could also look to roll it if I wanted to manage the trade a little bit. So I have to be willing to accept the consequences of a poor decision, right? So if some of you think that this stock is going to plunge well below 70 here in the coming months and years, then naturally you won't want to take that trade. Like I mentioned to my students here in my classes earlier today, you should only be taking the trades that you believe in. You should not be just blindly taking trades that other people are presenting. So if you're going to take a trade like this, you have to be somebody that is interested in owning Medtronic at a lower price than where it's traded today. It's trading at 77 bucks here today. You would then be on the hook for buying it at 70 if it traded below there in the middle of January. And remember, if it's yielding 3.5% at 77 bucks, it's going to be yielding much more than that at 70 bucks cost basis. So the further a stock's price goes down, the more attractive the yield becomes, and you'd like to think eventually yield hunters will step in and start supporting high quality companies like this aforementioned dividend aristocrat company. Okay, so that's what I had for you here today. I hope you enjoyed the presentation. If you did, and you want to encourage me to do another full-length video like this, including a trade application example when it comes time for me to do the video again on Thursday, I ask one simple request out of you, and it doesn't cost you a penny. All you have to do is take 5 seconds out of your day and click like for me there on Twitter. As long as we're up and over 100 likes, I'll plan on doing another full-length video. On the other hand, if you'd prefer this video to only be 15 minutes in length with no 12 grid analysis and no trade application example, then don't click like. And if we're under 100 likes, then we'll just keep it at an abbreviated video on Thursday. So I'll let you guys decide collectively there. Regardless of what you decide on that point, I do appreciate you checking out tonight's video, and I want to wish you all the best of success with your trades and your investments. Goodbye for now.